In today's session, we're going to be discussing Chapter 14, which deals with job order costing and process costing systems. And so when we talk about a costing system, we're really talking about what is the methodology by which a company gathers and accumulates cost related to the products they provide or the services they provide. And so we'll be covering the different alternatives available to management today. When we finished with this discussion, we should be able to distinguish between job order costing and process costing and what the differences are between those two different approaches to costing products or services. We should be able to prepare a summary journal entries for the typical transactions of a job order costing system. We should be able to use an ABC or activity-based costing system in a job order environment. We should be able to understand how service organizations use job order costings, that is, organizations that don't provide a tangible product per se, but a service. We should be able to explain the basic ideas underlying process costing and then how these differ from job order costing systems. We should be able to compute output in terms of equivalent units and compute cost and prepare journal entries for the principal transactions in a process costing system. We should be able to demonstrate how the presence of beginning inventories affect the computation of unit costs under a weighted average method, understand the concepts of transferred in cost in a process costing system with sequential processes, and we should be able to use backflush costing with a just-in-time or JIT production system. So we have a lot of topics to talk about today, and so let's move on with just talking about job order and process costing systems. And so the two most common systems of product costing are job order costing and process costing. Job order costing, or simply job costing, allocates costs to products that are readily identified by individual units or batches, each of which requires varying degrees of attention and skill. Industries that commonly use job order methods include construction, printing, aircraft, furniture, special purpose machinery, and any manufacturer of tailor-made or unique goods. Process costing, on the other hand, averages costs over large numbers of nearly identical products. It's often found in industries such as chemicals, oil, plastics, rubber, lumber, food processing, glass, mining, cement, and meatpacking. These industries produce mass homogeneous units that usually pass in continuous fashion through a series of uniform production steps called operations or processes. And so, at the heart of this, the core difference between the two is that under job order costing, we're able to identify job A, job B, job C. And there are characteristics that differentiate job A from job B from job C. And there are generally substantial differences in the either materials or the processes or the services that characterize each of those individual jobs versus process costing, where it's very difficult to distinguish between different units of output. And so, for instance, we produce 100,000 gallons of some product, and that 100,000 gallons, it would be very difficult to distinguish between gallon number 1 and gallon number 9,999. And so in that case, we're applying and accumulating and applying costs differently than we would be under this idea of job order costing. So the centerpiece of job costing system is the job cost record, also called the job cost sheet or job order. The job cost record contains all costs for a particular product, service, or batch of products. A file of job cost records for partially completed jobs provides supporting detail for the work in process inventory account, often simply called work in process. A file of completed job cost records comprises the finished goods inventory account. The job cost record summarizes information contained on source documents such as material requisitions and labor time tickets. Material requisitions are records of materials used in a particular job, and the labor time tickets or time cards record the time a particular direct laborer spends on each job. So let's look now at an example of a job cost record. This is a completed job cost record, and sample source documents. And so at the top in green, we can see the job cost record, and it shows for this particular job in the machining department, job number 963, having completed 12 units, we can see what the direct materials are, and we can see what the direct labor is. And underneath, in purple and in tan, to the left, we see the direct materials requisition sheet, which says here's how much we ended up requisitioning 6-inch bars, 24 6-inch bars at a unit cost of $5 each, which meant this job got charged with $120 for that line item of direct material. In the direct labor section in the green above, we see that there was drilling needed from the machining department. And so this represents an employee's time record. It shows the start, the end timing, the number of hours worked, the rate that they're paid, and the amount, and then the job that each of those different lines got charged against. And so we see that accumulated also on this job cost record. So again, the job cost record is a summary of all of the details of the direct materials requisitions, the labor time ticket, and other source documents. And so this is an example of the general flow of costs through the Enriquez Machine Parts Company's job order cost system. And so we can see, so we have direct materials that are purchased on account. They're then requisitioned. Line item 2, the direct materials are then requisitioned for manufacturing. There's direct labor costs incurred in that manufacturing. There's factory overhead. Because there's manufacturing, there's factory overhead that's incurred and then applied, which all results in a cost of goods completed and transferred to finished goods inventory. We have a sales on account, and then when we have sales on account, we recognize the cost of goods sold associated with this. And so again, this shows from a journal entry perspective, and these all represent T accounts, the bookings, the recording, how we journalize the transactions that we just talked about. And so they'll all end up resulting in a debit or a credit to a particular general ledger account. And this diagram is just meant to show the flow of those transactions through the general ledger using T accounts. So it would be a good idea to take the numbered lines from the previous slide and compare them to the journal entries that and then this actually shows those journal entries. So for instance, transaction number 1, we purchased direct materials of $1.9 million on account. The journal entry to record that is increasing or debiting direct materials inventory because it's an asset which we increase with debits, and crediting accounts payable because it's a liability and we say that they were purchased on account. On transaction 2, direct materials were requisitioned, and so when they're requisitioned, that means they're pulled from inventory and put into the work process flow. So in that case, the work process flow, which we call work in process, is an inventory, a short-term inventory account. And so we increase that with a debit of $1.89 million, and we credit the direct materials inventory because we're pulling it out of direct materials and putting it into work in process. And the same is true with the direct labor cost incurred of $390,000, and that's transaction 3. We're debiting work in process because that direct labor is incurred in the support of manufacturing of that product, so it goes as a cost against that job, right? And we'll pay those laborers eventually, so the credit goes to accrued payroll, which is a liability account. So again, it's a good idea to kind of continue to look back and forth at the previous slides and make sure that you're comfortable with and familiar with the journal entries that are necessary to record these transactions. So transactions 4A and 4B deal with factory overhead cost. In transaction 4A, we charge the actual factory overhead cost as a debit to a summary account called Factory Department Overhead Control, which we temporarily regard as an asset. Each department will have a variety of detailed overhead accounts to help control overhead, but for our purposes, we summarize them all into factory overhead factory department overhead control account. And so for transaction 4B, we apply factory overhead cost to jobs by debiting or increasing work in process and crediting or decreasing the factory department overhead control. So we think of the control account as just a temporary holding account where we book all of our overhead costs to, and then in order to improve the accuracy, to know how much it costs us to manufacture this product, or this job, to complete this job, we then move all the direct and indirect costs into this project or to work in process. The direct costs we've already moved as we've used them, and we saw those in the transactions 1, 2, and 3. And so now what we're doing is moving out of this holding account the overhead cost associated with this job, and it's moved out of this account based on an allocation methodology, and we talked about different methods and ways of doing that earlier. And so here you can see we're debiting work in process because we're increasing the cost of this job for the factory overhead, and we're crediting the factory overhead control account because we're that is the account where the accumulated pool of these factory overhead costs is housed. So as we talked about in Chapter 13, to compute the budgeted overhead rates, we need the following for each department: the cost allocation base, the budgeted overhead cost, and the budgeted amount of each cost allocation base. Enriquez allocates overhead based on machine hours in machining and direct labor costs in assembly, and they result in the following overhead rates. So we see that we have a machining rate of $4 per machine hour, and we have an assembly cost of 50% per labor dollar. And so using these rates, we apply the overhead for 20x1 for that year, which ends up being $375,000. And we see the calculation of that $370,000 as the actual machine hours of 70,000 times the $4 per hour rate, and then the assembly overhead being applied as the actual direct labor cost of $190,000 times the 50% rate, to get to a total factory overhead applied of $375,000. And the entry to record that is to increase the WIP, or our work in process asset account, and to decrease the factory department overhead account. And so we continue on with the transactions 5, 6A, and 6B, which recognize the completion of production and the eventual sale of the goods. When Enriquez completes a particular job, it transfers the cost assigned to that job to finished goods inventory. So they come out of work in process. That's where we see our credit to $2.5 million, and they go into finished goods inventory, which means we have now finished goods inventory balance of $2.5 million sitting there waiting for a sale to happen. So when it sells the job, these same costs become expenses on the income statement in the form of cost of goods sold. And so 6A records the sale, and we see the transaction sales on account $4 million. So because they're on account, we debit accounts receivable, which is a debit account, or an asset account, which increases by debits, and we credit the sales account, which is an income statement account. Now we recognize the sale associated with that finished goods inventory. We move the finished goods inventory off the balance sheet. That's out of the finished goods inventory asset account, which creates a credit of $2.48 million into the income statement, or the cost of goods sold expense account, which is increased by a debit of $2.48 million. And so this is literally the accounting of and how that process flow of goods and materials, and overhead, how it flows through the process, through the manufacturing and sales process. All of these entries up to this point have been reflective of what the accounting journal entries would be to record that under a job cost system. So finally, Transaction 7 in Exhibit 14-2 deals with differences between actual and applied overhead. So in 20X1, Enriquez applied $375,000 of overhead to its products, but actually incurred $392,000 worth of overhead costs. We call this difference under applied overhead because the amount applied is less than the amount incurred. The opposite, over applied overhead, occurs when an amount applied exceeds the amount incurred. So, as discussed more on pages 536 through 538 of Chapter 13, the Enriquez Company disposes of under or over applied overhead by some method at year end. We'll assume it uses the immediate write-off method, so it adds the $17,000 of under applied overhead to cost of goods sold. And that's what our journal entry here, number 7, is doing. It's debiting cost of goods sold, so it's increasing the cost on the income statement and decreasing the holding account or that balance sheet account of factory department overhead control. And so regardless of the nature of its production systems, firms will inevitably have resources they share among different products. The cost of these resources are a part of the overhead the company must account for. In many cases, the magnitude of overhead is large enough to justify a significant investment in a costing system that provides accurate cost information. Whether companies use this cost information for planning and control or product costing, often the benefits of more accurate cost exceeds the cost of installing and maintaining the cost system. As we've seen, ABC usually increases costing accuracy because it focuses on the cause and effect relationship between work performed and the consumption of resources. However, I would also note that ABC also creates a much more expensive costing system due to the nature of what's involved to accumulate, allocate, maintain, and effectively explain and get managers to understand how overhead is impacting their product cost. Dell began developing its ABC system by focusing on the most critical or core processes across the value chain. These were the design and production processes. After it put the initial system in place, Dell added the remaining phases of the value chain. Exhibit 14-3 shows the functions or core processes that add value to the company's products and how Dell assigns the cost of these functions to an individual job under the current ABC system. To understand product line profitability, Dell managers identified key activities for the R&D, product design, production, marketing, distribution, and customer service phases. Then they used appropriate cost drivers to allocate activity costs to the produced product lines. While each of the phases shown in Exhibit 14-3 is important, we will focus on the product design and production phases. Product design is one of Dell's most important value-added functions, providing a defect-free computer product that is easy to manufacture and reliable to use. Engineering costs, which primarily comprised of salaries and CAD equipment depreciation, account for most of the design costs. These costs are indirect, and thus Dell must allocate them to product lines using a cost allocation base. Service and nonprofit organizations do not usually call their product a job order. Instead, they may call it a program or a class of service. A program is an identifiable group of activities that frequently provide services rather than goods. Examples include a safety program, an education program, or a family counseling program. Another example could be a quality control program. Accountants also can trace costs or revenues to individual hospital patients, individual social welfare cases, and individual university projects. However, internal departments and service organizations often work simultaneously on many products, so the job order costing challenge is to apply the diverse department costs to the various programs in a fair and equitable manner. Only then can managers best allocate limited resources among competing programs. In many service organizations and some manufacturing operations, job orders provide not only product and service costing, but also planning and budgeting benefits. A public accounting firm might have a condensed budget for 20x1 as follows. Budgeted overhead rate equal budgeted overhead divided by budgeted direct labor. The budgeted total cost of an engagement is the direct labor cost plus applied overhead of 260% in this example of direct labor cost plus any other direct cost. And we see the calculation of that overhead rate in this slide. We have budgeted overhead of $6.5 million, and then we have the budgeted direct labor of $2.5 million, and if we apply overhead based on direct labor, we're going to apply 260% overhead to every dollar of labor. And that's not uncommon. I mean, this rate sounds high, but this is not uncommon for professional services firms when you consider all of the large amounts of indirect costs, such as insurances and employee benefits and facilities, general and administrative. So it's not uncommon. This is often actually referred to as an effective labor multiplier. So it says for every dollar of cost, what's the multiplier I have to apply to that and charge my customer gets reflected in the price that I charge for it in order to get back my direct costs plus the indirect loadings. And in this case, it would be 260%. So for every dollar of labor I charge or that I incur on a project, I have to charge the customer $2.6 or $2.60 in order to get the dollar back of labor plus the indirect cost associated with the labor, and then I would have to put a profit on top of that. And so suppose that this accounting firm's policy for pricing is 200% of total professional costs plus travel costs. The cost accounting system a company uses depends on the nature of its products and services. Process costing systems apply cost to homogeneous projects in a company that a company mass produces in continuous fashion throughout a series of production processes. Examples include chemicals, flour, glass, toothpaste, paper, and potato chips, as well as computer chips. These processes usually occur in separate departments, although a single department sometimes contains more than one process. And so a lot of times, we listen to the examples that were being provided: chemicals, flour, glass, toothpaste. They sound a lot like commodities, right? The journal entries for process costing systems are similar to those for the job order costing systems. Job order costing has one work in process for each job. There is one work in process account for each processing department. So work in process for cooking and work in process for freezing in our example. So as we said earlier, under the process costing, we have a work in process account for processes, not for jobs. So the process costing approach does not distinguish between individual units of production. Instead, it accumulates costs for a period and divides them by quantities produced during that period to get a broad average unit cost. We can apply process costing to non-manufacturing activities as well as to manufacturing activities. For example, we can divide the cost of getting state automobile driver's license tests by the number of tests given, and we can divide the cost of a post office sorting department by the number of items sorted. And so let's just set the stage for the application of process costing examples similar to what we did with the job order costing. So this toy company buys wood as a direct material for its forming department, which processes only one type of toy, marionettes. It inserts all the woods into this department at the beginning of the process, and then after forming, the company transfers the marionettes to the finishing department where workers hand shape them and add strings, paint, and clothing. So that's the product that we're looking at costing using a process costing approach. And so here we're saying that the forming department had no beginning inventory and completely manufactured 25,000 identical units during April, leaving no ending inventory. The costs were as follows. We had direct materials of $75,000, direct labor of $15,000, factory overhead applied to $40,000, which resulted in a total cost to account for of $130,000. So since there's no ending inventory, the unit cost of goods completed is simply $130,000, which is the dollar cost we accounted for above, divided by the $20,000 units, or $25,000 number of units that were processed that month to get a $5.25 per marionette cost. And so then, how should the forming department calculate the cost of goods transferred and the cost of goods remaining in the ending work in process? The answer lies in these key steps. So we have to summarize the flow of physical units. We have to calculate output in terms of equivalent units. We summarize the total cost to account for, which are the costs applied to work in process. We calculate the cost per equivalent unit, and then we apply cost to units completed and to units in the ending work in process. So we want to be sure that we state output not in terms of physical units, but in terms of a different unit measure called an equivalent unit. Equivalent units are the number of completed or whole units that the department could have produced from the inputs applied. We determine equivalent units by multiplying the physical units by the percentage complete. So we determine equivalent units of partially completed units by multiplying physical units by the percent of completion. This equivalent unit measure correctly equates the completed physical units that are transferred out of the partially completed physical units in ending inventory. So step 3 summarizes the total cost to account for. That is, the total cost incurred and applied to work in process forming. Step 4 obtains unit cost by dividing two categories of total cost by the appropriate measure of equivalent units. The unit cost of a completed unit, which is materials cost plus conversion cost per equivalent unit, is $3 plus $2.50, which equals the $5.50. So why is the unit cost $5.50 under this method instead of the $5.20 calculated earlier? That's because the $55,000 conversion cost is spread over 22,000 units instead of 25,000 units, because the 22,000 are the equivalent units versus 25,000 used in the earlier example. Step 5 then uses these unit costs to apply cost to products. The 20,000 finished units are completed in terms of both direct and conversion cost. Thus, we can multiply the full unit cost times the number of completed units to determine their cost, which is 20,000 units times $5.50 or $110,000. The 5,000 physical units in ending work in process inventory are fully completed only in terms of direct materials. Therefore, the direct materials applied to ending inventory work in process are 5,000 units times $3 or $15,000. However, these 5,000 physical units are 40% complete in terms of conversion cost. So here we're calculating this idea of equivalent units. Therefore, the conversion costs applied to work in process are 2,000 equivalent units. That's 40% times the 5,000 physical units times $2.50 or $5,000. Thus, the total cost of the ending inventory is $20,000. So step 3, and this gives the that calculation where we talked about step 3, step 4, and step 5. And so again, as you're thinking about what we just talked about, this kind of gives us the way of looking at that. And these are the journal entries, and you'll note they're very similar to what we had calculated using job costs. It's just because we have a different process flow and we have different costs, we may have slightly different twists on journal entries under the process flow versus the job cost flow. And so then we want to talk about this weighted average process costing. This method determines total cost by adding together the cost of, first, all work done in the current period, and then secondly, the work done in the preceding period on the current period's beginning inventory work in process. Then divide that total cost by the total equivalent units of work done today, whether that work was done in the current or previous period. Many companies that use process costing have sequential production processes. That is, so step A occurs, step A is completed, and the product moves to step B, and then step B is completed, and the product moves to, so it's sequential. For example, Oakwood Wooden Toys transfers the items completed in its forming department to the finishing department. The finishing department would label the cost of the items it receives from the forming department as transfer in cost. That is, costs incurred in a previous department for items that have been received by a subsequent department. They're similar but not identical to additional direct materials costs incurred in the finishing department. Because transferred in costs are a combination of all types of costs, that is, direct materials and conversion costs incurred in previous departments, they should not be called direct materials costs in the finishing department. And so we have this idea of we have transferred in costs, and then we have direct material costs that are also incurred in the finishing department. And so Exhibit 14-9 shows the first two steps in the process costing method, computation of physical units and equivalent units. The computation of equivalent units ignores where the 31,000 units to account for came from, either beginning work in process or those started in May. And so we can see in step 1, we identified the percentage complete that a product is with respect to work in process and what's transferred out. And then in step 2, we calculate the equivalent units of that. And so in this step, we also are taking those equivalent units and applying costs based on the weighted average method. And so now let's talk a little bit about organizations using JIT or just-in-time production systems. These organizations usually have very small inventories or no inventories at all. And that's the point of a just-in-time system, right, is that we transfer in products or transfer in materials as they're needed to complete products that are then sold immediately. We're not building up a supply of inventory. That's not just-in-time. Backflush costing is an accounting system that applies cost to products only when the production is complete. Backflush costing has only two categories of cost, material and conversion cost. Its unique feature is an absence of a work in process account. And so let's walk through an example of that. So STI, or Speaker Technology, produces systems for automobiles or speakers for automobile stereo systems. STI recently introduced a JIT or just-in-time production system and backflush costing. Consider the July production for speaker model AX27. The standard material cost per unit of AX27 is $14 and the standard unit conversion cost is $21. During July, STI purchased materials for $5,600, incurred conversion cost of $8,400, which included all labor costs and manufacturing overhead, and produced and sold 400 units of AX27. And so here again we see the journal entries that would be recorded as a result of the transactions that we just talked about. So for item 1, we see that we record the actual materials and conversion costs as a debit to materials inventory and a credit to accounts payable. So similarly, we add the direct labor and manufacturing costs to conversion costs with a debit to conversion costs and a credit to accrued wages and other accounts. Then we apply these costs in step 2 to units completed. So when production is complete, we transferred the cost from materials inventory and conversion cost accounts to finished goods inventory based on the number of units completed and the standard cost for each unit. So we completed 400 units at a cost of $35, a standard cost of $35 per unit. So we we debited finished goods inventory for $14,000, which is the $8,400 plus the $5,600, and then we cleared the materials inventory and the accounts payable. The conversion cost, the materials inventory and conversion costs for $5,600 and $8,400 respectively. So now we need to apply the cost to completed units. When production is complete, we transfer the materials from materials inventory and conversion cost accounts to finished goods account, which we just talked about, based on the number of units completed and the standard cost of each unit. We record the cost of goods sold during the period. We transfer the standard cost of the items sold from finished goods inventory to cost of goods sold. And so you can see here we've made the sale, so we're debiting cost of goods sold for $14,000. Again, it's in an income statement account. We're crediting finished goods inventory, which is a balance sheet account, for the $14,000. And then underneath we say, suppose the company immediately delivers completed units to customers so that finished goods inventory are negligible. There we're saying, well, we can combine steps 2 and 3 to eliminate the finished goods inventory account. And again, that's essentially, right, the purpose of a just-in-time system is so that we don't end up with much in the way of inventory anywhere through our supply chain. So what if actual costs added to the conversion cost account do not equal the standard amounts that are transferred to finished goods? We treat these variances similar to overapplied or underapplied overhead. Backflush systems assume that account balances for conversion costs are approximately 0 at all times. Thus, we charge any remaining balance in the account at the end of the accounting period to cost of goods sold. So suppose actual conversion costs for July were $8,600 and the amount transferred to finished goods that is applied to the product is $8,400. We would write off the $200 balance in the conversion cost accounts to cost of goods sold at the end of the month, and that's what this journal entry does. And so this completes chapter 14. Again, it's this idea of job costing, process costing, just costing systems is a complex area, and so I would go back and reread the chapter again if this doesn't help any, and work through some of the examples there, and then move on, please, to the your discussion forums and your learning exercises. And thank you for your time.